Okay, we are about starting a new section. The session is on business combination and group accounts. And our resource material in this case will be my book, which I publish, and it's termed The Contemporaneous Accounting for Business Combination and Group Accounts, my idiosyncratic methodology, which you can obtain on Amazon for both the Kindle, which is the soft version, or the hard copy. I can also get in Nigeria for the hard copy. Okay, I think I'll start from what is our individual understanding of business combination and what brought about business combination, what is rationale or strategy behind it, and from there we'll take it up. I'll leave it open for anyone to put up the discussion, and others could support or vary the discussion as the case may be. Okay, over to you guys. I think Mr. Nitty want to say something. You are muted.
Okay. Thank you very much for giving me this opportunity. From my understanding of business combination is an arrangement whereby two or more entities comes together with their financial resources. Okay, before we can say there is business combination, it means it must involve two or more entities. As a matter, we have several forms of business combination. We have several forms of business combination. We have a form of merger and acquisition. We have a form of joint venture, and we have other form. If we say merger and acquisition, for example, it could be that a company A combine resources with the company B in form of having stake in each, for example, in form of a situation whereby one company.
You're muted. You're muted. You're muted.
Okay. It is an error. Now I said, can you hear me now?
Yes.
Okay, I said business combination can come in various forms. It can come in form of merger and acquisition. Business combination can come in form of joint venture, and it can also come in form of other form. But what I mean by merger and acquisition is that two or three companies can combine resources to form one single entity. And this could be as a result of so many factors. It could be to gain larger shares in the market. It could be to strengthen the operation of an entity. That is in form of merger and acquisition. For example, we can say that Access Bank and Diamond Bank recently come up in form of merger and acquisition, in which Access Bank and Diamond Bank form a single entity called Access Bank. There are other forms of business combination, but I will just stop here.
Okay, thank you for that contribution. Who else? Who else?
Okay, yeah, I think he has said a lot about business combination, which is the coming together of two or more companies when they join resources together, they join personnel together, um, they join financial and non-financial resources together to form a bigger and more formidable um, entity. So, and as I said, it comes in different forms, in the form of merger and acquisition, or in the form of joint venture, or in the form of takeover, like a bigger company buying over the shares of another company. And that one is always being consolidated. So that is my understanding of business combination, and also what happened between I think between there are different forms of merger and acquisition. Like I said, the one of Access Bank and Diamond Bank is an example of merger and acquisition. And we have different examples of company taking over the majority shares of another company to form a parent subsidiary relationship. So those are just different forms of business combinations that we have.
Okay. Who else? Who else? Who else? Babajide.
Mostly they've said all I would have said, sir.
Okay. Now, who can distinguish between a business combination and intercorporate investment? What is an intercorporate investment? In a literal sense.
Okay, babe, let me reduce the volume. Okay.
Yeah, is somebody talking?
So I think intercorporate investment is just when you are investing in a company or buying the shares of a company within the 20% of the total shares of the company. That's an investment. That's an investment kind of. But combination has to do with a takeover or a parent subsidiary relationship where you acquire more than 50% of the shares of the company.
Okay, let me start from intercorporate investment because something begets something. Intercorporate investment in its literal meaning implies when we say a corporate, a company invests in another company. And I believe we know that such can be done through various financial instruments. can we itemize those instruments that can be used to invest in another company by a company? The floor is open.
Yes.
You can go ahead, sir. Mr. Edele.
You can buy shares in another company.
Okay, that's
One can buy, yes. One can buy bonds.
Yeah, corporate
but
bonds.
your company can buy bond in another company. That's another one.
Yes.
What other ones can happen? What other one can happen?
Loan notes. We can buy the loan notes.
Which is like the venture stock. Yeah, you can borrow normally without creating such instruments. There can be purchase of commercial papers.
Yeah.
Okay, etc. Okay, once a company put its money in another company via means of this financial instrument, either by way of buying the company shares to inject money to it, or whether by way of buying the company bond to create a borrowing or a formal borrowing, or through the venture stock, or through any form of commercial papers, or any form of bespoke financing or arrangements, or structured financing, such is termed an intercorporate investment. Because primarily a company is set up to invest in itself and invest in its operation. But when you now, more or less, in addition to investing in your operation, you extend your fund towards investing in another company, such scenario or situation is termed that you have involved in an intercorporate investment. Now, can you give me rationale for each of those instruments you invest in? Why are you investing in it? If you invest by buying another company's shares, what is the rationale behind it? Or what may be the rationale? If you are buying another company's bond, you are lending money to another company, you are buying commercial papers of another company, can you more or less present the rationale and objective behind it? Madam Anayo, I've not heard your voice today. Madam Oladokun, I've not heard your voice today. Miriam Odun, we have not heard your voice today.
Well, let me give my little idea.
Okay, ma'am.
For good afternoon, sir. For shares, the rationale behind investing in a company's shares is either to have for the returns, that's for the dividend, that whenever the company makes profit and there's returns, so you get dividend, or also for controlling interest. So that's the rationale behind share investment in another company.
Okay, thank you. Madam Anayo.
For shares, the rationale behind it, I think, is for if I should invest in another company now, it's for me to have a say, which is same thing as interest, a controlling interest in that company, or to have a return, which is the dividend at the end of the period from the same company. Then for that of the bond, I think I would say is more of growing one's assets. For me, if I'm to loan my money to another person, rather than allowing that thing to just allowing the cash asset to just lay, follow like that. I think I will just, for me to invest it in another place, that means I want it to grow in another foreseeable years from what it used to be. So that is my take on the two.
Okay. Olawale, though you are in transit, can you contribute if you are there? Marian Odun, we await your contribution, and I can't see your face.
I think it's basically what both of them have said. For shares is to gain controlling interest in the other company, while
I can't see your face. Let me see your face so that I can flow.
I'm saying it's basically what both of them have said. I think for shares is to get controlling interest in the other entity, while for bonds is primarily to probably. I'm not so sure about bonds, but I think it's something to protect your assets also.
Okay. And now your contribution.
Okay, for shares, I think more is for wealth appreciation, because I look at it from major people that invest in shares, institutional. I'm looking at institutional investors. Mostly, they want to grow the wealth of those that are invested in them. So I think I look at it from that perspective for shares, to buy shares. So wealth appreciation. But if for those who want to actually take, then for those who buy bond, I think it's a way of investing idle fund so that they can get additional profit. That's the way I look at it for bond and for commercial papers. Then for shares, sometimes people may invest in shares that, in addition to what I said about shares, people may invest in shares in order to have some form of say they may invest in their competitors, different ways to have idea of what happens in that, and also to maybe to have controlling interest, that is, they are going to invest a lot. But that's my take on those issues.
Okay, thank you very much. If you marry everything everyone has said, you guys have said it all, okay? And we only just need to package it. That's what is left, okay? Now, one thing about this workshop is that I don't think many of us might have passed through this kind of workshop before, because this workshop is to make you not just an accountant of repute, not just a finance person of repute, but is to make you a business advisor, someone who need to have better understanding in order to participate and be in a position to support boards, investors, and the likes in decision making. Okay, which means our focus should not just be how do we account for something. But if you don't understand the rationale, the background, the strategy behind it, the intention behind it, the motive behind it, you can't be a better accountant of repute. You understand? Because gone are the days of just focusing on reporting what has happened. That is historic. Okay. Today we are moving towards be in a position which is forefront of putting ideas from your experience and from the knowledge of the past to bear in taking decision. That is where the value sits. Forward looking, not backward. Okay, and in that light, that's why you see that the approach we've adopted is that we need to understand the background of what we want to account for, beyond understanding the characteristics of what we are talking about. Okay, and that speaks volume, and that makes us a better accountant in trying to do the needful about what we are discussing. Now, as we start now, I want someone to I don't know who will volunteer to read what is on your screen. And that is going to lay a foundation to all of our discussion as we move on. And that is going to give more or less like an affirmative position and support to what every one of us have said regarding this discussion. Okay, Segun John, can you assist us in reading this?
Okay. Intercorporate investments represents an important component of management strategy, which involves a company investing in other companies to achieve diversification, growth, and competitive advantage. But the structure and scope of these investments creates comparability challenges for the potential investors, analysts, and investing public at large. Intercorporate investments can have a significant impact on the investing entity's financial performance and position. Companies invest in the debt and equity securities of other companies to diversify their asset base, enter new markets, obtain competitive advantages, and achieve additional profitability. Debt securities include commercial papers, corporate and government bonds and notes, redeemable preferred stocks, and asset-based securities. Equity securities include common stocks, otherwise known as ordinary or equity shares, and irredeemable preferred stocks. The percentage of equity ownership a company acquires in an investee depends on the resources available, the ability to acquire the shares, and the desired level of influence or control. Intercorporate investments can substantially be categorized as minority passive, minority active, and controlling interest investments, while the fourth category is joint venture or joint arrangement, which involves common and joint control. Percentage and percentage of ownership or voting rights is typically used to determine the appropriate category for financial reporting purposes, except in some extreme identifiable situations. However, the ownership percentage is only a guide, which is based on a rebuttable presumption and may be necessary and may not necessarily be the benchmark as as it will be discussed later in this text. Ultimately, the category of investment is based on the investor's ability to exert significant influence, joint control, or control the investees. Definition of intercorporate investment: securities that are purchased by corporations rather than individual investors. Intercompany investments allow a company to achieve higher growth rates compared to keeping all of its funds in cash. These investments can also be used for strategic purposes like forming a joint ventures or making acquisitions. Companies purchase securities from other companies, banks, and governments in order to take advantage of the returns from the securities. Marketable securities that can readily be exchanged for cash, such as notes and stocks, are usually preferred from this type of
Or
investment.
this type of investment?
Break down intercorporate investments. Intercorporate investments are accounted for differently than other funds held by a company. Short-term investments that are expected to be turned into cash are considered current assets, while other investments are considered non-current assets. When companies buy intercorporate investments, divided
Dividend.
dividends and interest revenue is reported on the income statement.
Now let's move to, we describe 4 things that intercorporate investment can give rise to. Okay, minority passive, minority active, controlling interest, and joint arrangement. Can you speak on them again? Continue.
Okay, minority passive. A company's ownership interest of less than 20% in the equity of another company can be considered a passive investment. In this case, the investor cannot significantly influence or control the investee. Minority passive investments are classified in accordance with IAS 39, Financial Instruments Recognition and Measurement of Financial Assets, or IFRS 9, where it has early adopted the standard. In the statement of financial position, when and only when the entity becomes a party to the contractual provisions of the instrument, the equity instruments can be classified as financial assets in the individual statement of the financial position of the investor. Equity financial assets will now to be measured at fair value at initial recognition, IAS 39, IFRS 9, while subsequent measurements at fair value through profit or loss and fair value through other comprehensive income will depend on the objective evidence to which the financial asset is held vis-a-vis other fundamentals, including business models. Minority active, an ownership interest between 20% and 50% is technically regarded as non-controlling investment for consolidation purposes. However, the investor is considered to have significant influence in the investee's business operations and decisions. Significantly influence can be evidenced by the following: board of directors representation, involvement in policy making, material intercompany transactions, interchange of managerial personnel, dependence on technology. It is possible to have significant influence with less than 20% ownership, but much more in an extreme case as considered in IAS 28, interest in associate and joint venture. In this case, the investment is considered minority active, investment in associates. Conversely, without significant influence, an ownership interest between 20% and 50% is considered minority passive, investment in financial assets. Interest in associate and joint entities will now to be accounted for using equity method based on the revised position of IAS 28, which became effective January 1st, 2013, as opposed to the requirements of the withdrawn standard IAS 31, interest in joint ventures, where the method of proportionate consolidation was permitted. Controlling interest, an ownership interest of more than 50% in the voting right of an entity, usually ascertained through shareholdings, is known as controlling interest investment. When the investor can control the investees, the consolidation method, acquisition method, is adopted in accordance with the principle of substance over form. The relationship of the parents and subsidiary from the economic point of view is considered as a single economic unit, even when from the legal point of view, every company is a separate entity. It is possible to own more than 50% of an investee and control does not exist. For example, control can be temporary or barrier may exist, such as bankruptcy, administration, or government intervention. In these identified scenarios, the investments may not be considered a controlling interest. Conversely, it is possible to control with less than a 50% ownership interest in the equity of the subsidiary, and invariably the investment may be considered controlling interest as contained in IFRS 3, revised in 2008. business combination and accounted for in the same way as required by IFRS 10 consolidated financial statements. Joint ventures / entities. A joint venture or entity is an entity where control is shared by two or more investors. Under International Financial Reporting Standards, IFRS, IAS 28 revised in 2011, interest in associates and joint ventures, the only recommended method of accounting for such interest in joint entities is the equity method. The proportionate consolidation as contained in withdrawn IAS 31 interest in joint venture is no longer required effective January 1st, 2013. So accounting for equity investments, when ownership is less than 20%, is minority passive or investment in financial assets. And the degree of influence is no significant influence. The accounting treatment is equity instruments accounted for as fair value through profit or loss and fair value through other comprehensive income. So when the ownership is between 20% to 50%, it is minority active or associates. The degree of influence is significant influence. The treatment is equity method. When the ownership is more than 50%, that is controlling interest or subsidiary. The degree of influence is control and the treatment is consolidation through acquisition method. When the ownership is 50-50 interest, it's a joint venture and the degree of influence is common or joint control and is treated as equity method. Regulatory requirements. International Financial Reporting Standards, IFRS, is as issued by the International Accounting Standard Boards, IASB, provides detailed guidance on accounting for all forms of business combinations and similar intercorporate investments that are not considered a business combination. The following standards give credence in the accounting or all form of intercorporate investments and business combination. IAS 37, separate financial statements. IAS 28, accounting for investments in associates and joint ventures. IAS 32, financial instruments presentation. IAS 39, financial instruments recognition and measurement. IFRS 3, business combinations. IFRS 9, financial instruments. IFRS 10, consolidated financial statements. IFRS 11, joint arrangements. IFRS 12, disclosures of interest in other entities. IFRS 13, fair value measurement. IAS 27, separate financial statements. IAS 27 contains accounting.
That's all. Thank you very much. Hello, thank you, Shegun. Thank you very much. Yeah. Now, what you've just done has laid and solidified the foundation to all what we have discussed earlier. Now, this summarizes every discussion that was made by everybody. But there's one of us that made more or less an insinuation, which I want to correct. When I told you guys to talk about business combination. Now, joint venture or joint arrangement does not constitute a business combination. Okay, that's why I later restructured it to say, okay, let us talk about intercorporate investments so that we can see the link. And later on, as we move on, you can see the distinguishing factor of what gives rise to business combination. Okay, thank you very much. Now, as I said earlier, intercorporate investment is just when, other than individual, a company investing in another company, whether by way of equity investment or debt investment. And the distinguishing factor between the two is that debt investment require the other company to repay its debt over time and as agreed. and it also pays interest in most of the times. Whereas for equity investment, the other company is not bound, nor does it have a mandate to repay you. What you have done is that you have assumed a risk as a risk bearer so that you participate in the returns, which does not have a limit in the other company. And as a risk bearer, you also participate in the loss, which is not known to a debt holder. A debt holder does not participate in your loss, is given a guarantee return, and most times, asset of the company is pledged against its repayment. Peradventure, the company is unable to meet up with its obligation. Okay, that's a distribution factor. But the conclusion we want to make up here is that when it comes to debt investment, the rationale behind debt investment is always limited to opportunity for investment to enhance returns. That is why you invest in debt. Okay, the opportunity is that you have idle cash, or you have cash of which the opportunity of investing in it is lower than investing in debt security, which has higher return in some cases. That is the only rationale for doing that. Okay, but when it comes to equity, the rationale goes beyond returns. Okay, because the return is not even guaranteed. Okay, and the return is discretionary at the instance of the company, and the return is subject to the performance of the entity. Okay, but there are other bigger picture to a company investing in another company via equity instruments. And this is because of what we discussed earlier, and which Shegun also read, that there are strategic objective to it. One of it is to probably gain entrance into another market, which is a diversification strategy. What it means is that if, for example, I want to gain entrance into Ghana market, it will be difficult for me as a Nigerian company to just go there, set up a company and start to market, do all sorts of things. It's going to be very difficult, even when the climate is there, suitable for you to gather customer, for you to have all sorts of things might take a very long period of time. Now, what do? You rather look for an existing company where you can buy into and use it to unveil yourself into that market. That's one strategy. Another strategy of it is that you might want to use it as a way of integration within your value chain, whether by way of forward integration or backward integration. Forward integration is this: if you are a manufacturer of a product, you can want to do a forward integration by acquiring a distribution channel so that it can give you a leverage to pushing more of your product than that of the competitors. And that might be the strategy beyond just return from that entity. Backward integration might be that you are a distribution channel and you want to more or less gain sole ownership of the right to distributing that product. By way of you investing in the manufacturer or the main wholesaler, or as the case may be, you can also do what we call a backward integration by taking over that market. Or you can want to more or less take a market that is more or less all-encompassing by making yourself a conglomerate, whereby you look at the economy or you look at the industries and you see that what are the primary industries there where you can be able to buy into some selected companies so that you become a market dominance in that industry or in that economy. Okay, and that is also what you need to take into consideration. Therefore, there are a lot of rationales that create synergy, that create new markets, that is for diversification and some other things in order to enhance your return on a long-term basis, which is sustainable. Okay, these are the things we need to take into consideration as a rationale for intercorporate investment via equity instruments. Okay, now for the equity instrument is what this diagram that you can see on the screen speaks to. Okay, and let me put up the spotlight so that you can be able to see it well. Now, let me try and pin this stuff. I don't know why it's rotating so much. Okay, let me just reduce it to this. Okay. Now, when you invest by equity in a company, we do consider, even though if you look at what Shegun read, there's a rebuttable presumption that it might not be in all cases. But on average, whenever you invest and your investment fall below 20% or thereafter, we consider such investments in the equity of another entity as something that barely gives you a significant influence. In that situation, we call it a minority passive investment. Okay, and such can be measured in line with the requirement of IFRS 9. And IFRS 9 deals with financial instruments. Okay, where the categories can either fall as fair value to profit or loss or fair value to other comprehensive income. Later on in this workshop, we will discuss extensively on financial instruments. Okay, and secondly, there are situations where your investment might cut across 20%, but it's not up to half or more than half of the voting rights. What constitutes voting rights is your interest in the shares of an entity. Now, if you find yourself in a situation of within 20 to 50% of the ownership of the shares of the company, such can be considered minority active, where you start to participate in the financial and operating policies of the company. And in that situation, we say there is more likelihood that you have created significant influence. And in that situation, equity methodology is what will be put to use. And as time goes on, we'll get better understanding of it. Now, the only one that constitutes business combination in all respects is that you have more than half of the voting right, which predominantly gives you control. And in that instance, we talked about you consolidating the result of the other entity. And what does consolidation depict? Those are the things we'll look at later once we move from this level towards group accounts. Okay, and the final aspect that you could give rise to by way of equity investment in another company is a situation where you have a common control and that control is jointly held. Okay, and in that situation, we say we have a joint venture. And in such a joint venture, what you also use, it will be in tandem with what we use for investments that gives you minority active, or what you call the investment in an associated company. And in that situation, you use equity method. What does equity method depict is what we also discussed in line with the requirement of IAS 28. Now, as he has also said, various regulatory requirements via the requirement of international financial reporting standards. The standards that we'll make use of primarily will start from IFRS 3, because that is what is going to lay the foundation for business combination. Okay, whereas IAS 32, IFRS 9, or IAS 39 as at old standard, and IFRS 7 will lay more foundation to financial instruments as a whole, which we are going to discuss later extensively. But as we move on, we'll transit from business combination, which more or less ends at the point of acquisition, towards preparing consolidated financial statements. And we'll also evaluate as time goes on, is it in all instances that a business combination will require or result in the preparation and presentation of group accounts? At what point do we prepare group accounts? At what point do we need not prepare group accounts? What is rationale behind it? All of these are what we are going to demystify in the course of this discussion. Okay, and that is just an introduction to what may give rise to business combination, even though we are here to discuss extensively on what constitutes a business combination. Any contribution, question at this point?
Apologies, sir. Please, Wale, You mentioned something about equity methods, sir. Can you please shed more light on equity method?
Okay, at this point, we are not discussing on any of the methods. We are just introducing those methodologies as a passage, you understand? As time goes on, we will delve into them one by one. You get what I'm saying now? Because there's a flow and sequence to this discussion. Otherwise, we might not be able to grab it in a manner that will be appreciated and understood.
Okay, sir.
Thank you.
Okay, sir, if I may just add something to the rationale for intercorporate investments. You know, bigger companies, they like to acquire these young startups. You know, it's like what is very, very common at the moment, because they like to take advantage of their fast-paced environment and innovative capacity of the startup, of the different startups. So that is another rationale why big companies invest in smaller ones.
Do you know that there's a primary rationale behind that, which you have not mentioned? It's not that they just want to take over those startups. There's something that is the motive behind that decision. Who can tell me the motive behind that decision? Something critical, sinister.
Is it to eliminate competition?
Yeah, you are close to it. It's because of their threats. And at that early stage, take over them before they become a club in a way. Do you guys? It's not about catch them young. Catch them young is like you want to support people to grow. This one is curtail them before they become a threat. You understand? If Nokia knew early enough that the likes of Samsung and Apple, when they were so babyish, they would have taken them over by giving them something juicy. You can say now. You know, there's this Yoruba that says, no, I don't know how, it skipped my mind now, but what you say is that when something is small, quickly cage it before it becomes a bigger stuff that you cannot control, which might later consume you yourself. Mr. Ayodele, you want to say that Yoruba stuff? Mr. Ayodele, no, you are on mute.
Yes, my network is very bad.
Yeah, okay. You want to say something about that Yoruba adage?
Yes, I was trying to say that kékeré là ń pẹ̀ka ìrókò. Tó bá ti dàgbà tán. That is at young that you preparing control the plant of iroko tree, so that
once it develops iroko, the root can be from here to about 1 kilometer, which it will not be difficult for you to uproot. That's what it means. Okay, Shelby, thank you for that contribution. Any other contribution? Any other contribution? Any other contribution? Madam Grace, we are waiting for you. We can't hear you. You are on mute.
I've been offline since I just joined. I don't know, I had issues. So.
No. We have not said anything. We just needed to contribute about intercorporate investment at the simplest language you have mentioned it.
Yeah, Mr. Shegun just said a critical, mentioned a critical point there about taking over, and the one that they use the Yoruba adage to expansion. These are the reasons why most companies, take over organizations, and some they invest in order they can take over in future. That's just my little contribution.
Okay, thank you. Thank you, ma'am. Any other contribution?
Please, mine is a question.
Continue.
Okay, so I wanted to know, so on the surface level, what's the difference between the corporate investment and business combination?
Okay, I think what we mentioned is that intercorporate investment, as simple as it is, means a company investing in another company. Very straightforward. But there are some aspects of intercorporate investment that give rise to business combination. And that is the next level we are going to get to. And we only get there when we are able to explain what is business combination itself, so that we'll now come back to this corporate investment we discussed and see which one of them actually give rise to business combination. Does that make sense?
Yes.
Okay. Now, let us talk about business combination. What is a business combination? Miriam, you trigger this question. Therefore, you be in a position to do this for us. Let me enlarge it. Okay, over to you, ma'am.
Business combinations. IFRS 3 business combination outlines the accounting when an acquirer obtains control of a business, example, an acquisition or merger. Such business combinations are accounted for using the acquisition method, which generally requires assets acquired and liabilities assumed to be measured at their fair value at the acquisition date. Business combination entails a transaction or other event in which an acquirer obtains control of one or more businesses. Transactions, sometimes referred to as true mergers or mergers of equals, are also business combinations, as that term is used in IFRS 3. Definition of a business: an integrated set of activities and assets that is capable of being conducted and managed for the purpose of providing a return in the form of dividends, lower cost, or other economic benefits directly to investors or other owners, members, or participants. A business consists of inputs and processes applied to those inputs that have the ability to create outputs. Although businesses usually have outputs, outputs are not required for an integrated set to qualify as a business. The three elements of a business are defined as follows. 1. Input: any economic resource that creates or has the ability to create output when one or more processes are applied to it. Examples include non-current assets, including intangible assets or rights to use non-current assets, intellectual property, and the ability to obtain access to necessary materials or rights and employees. 2. Process: any system, standard, protocol, convention, or rule that, when applied to an input or inputs, creates or has the ability to create outputs. Examples include strategic management processes, operational processes, and resource management processes. These processes typically are documented, but an organized workforce having the necessary skills and experience following rules and conventions may provide the necessary processes that are capable of being applied to inputs to create outputs. Accounting, billing, payroll, and other administrative systems typically are not processes used to create outputs. 3. Outputs: the result of inputs and processes applied to those inputs that provide or have the ability to provide a return in the form of dividends, lower cost, or other economic benefits directly to investors or other owners, members, or participants. To be capable of being conducted and managed for the purposes defined, an integrated set of activities and assets requires two essential elements: inputs and processes applied to those inputs, which together are all will be used to create outputs. However, a business need not include all the inputs or processes that the seller used in operating that business if market participants are capable of acquiring a business and continue to produce output. For example, by integrating the business with their own inputs and processes. The nature of the elements of a business varies by industry and by the structure of an entity's operations or activities, including the entity stage of development. Established businesses often have many different types of inputs, processes, and outputs, whereas new businesses often have few inputs and processes, and sometimes only a single output or product. Nearly all businesses also have liabilities, but a business need not have liability. An integrated set of activities and assets in the development stage might not have output. If not, the acquirer should consider other factors to determine whether the set is a business. Those factors include, but are not limited to, whether the set has begun planned principal activities, whether the set has employees, intellectual properties, and other inputs and processes that could be applied to those inputs, whether the set is pursuing a plan to produce outputs and will be able to obtain access to customers that will purchase the outputs. Technical note: not all of those factors need to be present for a particular integrated set of activities and assets in the development stage to qualify as a business. Determining whether a particular set of assets and activities is a business should be based on whether the integrated set is capable of being conducted and managed as a business by a market participant. Thus, in evaluating whether a particular set events whether a seller operated the set as a business or whether the acquirer intends to operate the set as a business. In the absence of evidence to the contrary, a particular set of assets and activities in which goodwill is present shall be presumed to be a business. However, a business need not have goodwill. There is a typical diagram of what constitutes a business: input plus process, which is input plus process equals to output. These activities are necessary for a business. The requirement of IFRS 3 and accounting for business combination does not apply to 1. The accounting for the formation of a joint arrangement in the financial statement of the joint arrangement itself. 2. The acquisition of an asset or a group of assets that does not constitute a business. In such cases, the acquirer shall identify and recognize the individual identifiable assets acquired, including those assets that meet the definition of and recognition criteria for intangible assets in IAS 38, intangible assets, and liabilities assumed. The cost of the group shall be allocated to the individual identifiable assets and liabilities on the basis of their relative fair value at the date of purchase. Such a transaction or event does not give rise to goodwill. 3. A combination of entities or businesses under common control. Advantages and disadvantages of business combination. The main objective of a business combination is to eliminate cutthroat competition and secure the advantages of large-scale production. The following are the advantages of business combination. 1. Competition between and among the companies will be eliminated. 2. The amount of capital can be increased by combining businesses. 3. Establishment and management costs can be reduced. 4. Benefits of large-scale production can be secured. 5. Operating costs can be reduced by avoiding duplication. 6. Research and development facilities are increased. 7. Monopoly in the market can be achieved. 8. Economic of scale, that is bulk purchase of materials at a reduced price, is possible. 9. Stability of the price of goods is maintained. The following are the disadvantages of business combinations. 1. The business combination brings monopoly in the market, which may be harmful to the society. 2. 2, the identity of the old company finishes. 3, goodwill of the old company decreases. 4, management of the company becomes difficult. And 5, a business combination may result in overcapitalization. Thank you.
Thank you very much. Thank you very much. You've laid the foundation in which you build it. Now, can anyone say one or two things you pick up from what constitutes a business combination before I delve in?
I just want to mention some of the importance which I heard when she read. So, like in a business, there's so many competitions, and this competition affects prices of goods. It affects output. It affects their profit. So, two businesses coming together will eliminate that competition. That's on the good side. But over time, if care is not taken, it might also create monopoly, and that is not going to be in favor of the customers and buyers, because prices of goods can just be increased. They'll be buying things for high prices because there's no competition. They can't move to another buyer, you know. So those are the things that I've picked so far.
Okay, thank you. Who else?
Okay, I think I can add to that. Yeah, so there's something she talked about: the inputs, the process, and the outputs. So the inputs are just things like the assets of the company, the liability, and the processes are like the experienced employee of the company to be taken over, and the outputs, maybe the products and the services of the company. So what actually constitutes business combination is a combination of the inputs and the processes, and not necessarily the combination of the three: input, process, and output. But when you acquire the input of a company and you also acquire the process, it is already a business combination, even if there is no outputs at the moment. So that is my contribution to it.
Who else? Babajide? No comment, sir. Okay. Mr. Ayodele? You are muted.
Yeah, I'm just coming up again because my network is bad. What was the question, sir?
Okay, I think it is. Okay, I will skip you, but the question is about what we discussed when I think you were offline. And now,
I'm here.
Yeah, what can you say about what we have put together with respect to business combination before we move further?
Okay. I think everything is not what she said is I do understand what she read, but for me, there's something I wanted clarification on from you regarding business combination. I don't know if I can say it now. Now, in terms of business combination, look at it from a perspective of having more than 50% ownership of a business. So, for instance, that is business combination, and then you consolidate. But there's another type again, for instance, where you acquire and it becomes yours. You like acquire and merge and become one. Do you still call that a combination?
Okay. Madam Grace, yeah, I said we'll come to that. Madam Grace. Hello, Madam Grace, we can't hear you. Hello, ma.
Go on, sir.
Okay. Now, let's break it down one by one. The first thing we need to take note of. Let me share my screen. We'll pick it one by one. The first thing we need to take note of now. I'm trying to correct my pen. I don't know why it's trying to malfunction. So let me try and reconnect the pen. I think there's a setup issue. Just give me some minutes to reset the pen. Okay, as we're saying, now to talk about business combination, what is a business combination? We need to first of all separate it into business and combination. A business for this purpose How is it being defined? Because we didn't say company combination, we talked about business combination. And what this is telling to us is that not all companies may qualify as a business. I repeat, not all companies may qualify as a business. The question then is, what then is a business? We are going to look at a business from financial reporting perspective. First, in considering a business, we agree that it is a set of interrelated activities. An integrated set of activities. And we also recognize that it has three components. Who can list the three components of a business?
Is the input, the process, and the output.
The input, the process, the two should give rise to what? An output. Now, though these three are required, but not necessarily for us to have an output, but two must be present at all times.
Is it not there? Sorry, I thought you have it.
But invariably, it is expected that over time, the three should be present. Now, when we say input, what do we refer to as an input in a business? Who can explain? What's an input in a business? Who can explain?
For input, we are talking about the resources we injected in a business, such as cash, human capital, assets, and what have you.
That's correct.
Now, also the input need not to be complete, but there's a significant input that can allow the company to function. The next one is the process. Who can tell me what the process stands for in a business?
Okay, if I may try, sir. Yeah, the process is activities needed to convert the inputs into an output. And that could mean the experienced personnel of the company and other factors that are needed to transform the inputs into the desired output.
Can you demonstrate it in practical terms?
Okay. For example, let's assume a manufacturing company that's manufacture, let's say, cement. So the input will be the raw materials and the machinery and other things put in place, while the process will be the series of interconnected activities that transform that output. And why I also included the employees, because they are part of the process, the experienced one. They are part of the process of transforming that input into the output. And the output is the cement that we have from limestone. Limestone is part of the input. The plants, the manufacturing equipment, they are part of the inputs, and the output is the cement that we have. So I think I've been able to explain.
Can you read further what process stands for here?
Any system, standard, protocol, convention, or rule that, when applied to an input or input, creates or has the ability to create outputs. Example includes strategic management processes, operational processes, and resource management processes. These processes typically are documented, but an organized workforce having the necessary skills and experience following rules and conventions may provide necessary process that are capable of being applied to inputs to create output. Accounting, billing, payroll, and other administrative systems typically are not processes used to create outputs. Are you with us, sir?
Maybe he has network issues. Should I continue from when we were stop class?
If you want to take over, no problem.
Continue now.
Well,
Continue, go ahead.
I don't want to show myself. I don't want to show myself.
Try and do.
Unfortunately, I'm on the road and I'm driving now, so it will not be safe to be, driving. And let's call Muyiwa now. Jide, help us call Muyiwa. Maybe let me try.
I'm sure he must have been trying to log him back.
Yeah.
Maybe his subscription has finished or something.
No, he said he's trying to switch.
Okay.
Sergeant Rodriguez,
Shit,
U.S.
shit,
Attorney
shit,
called
shit.
That was the warning we gave out. But a lot of people misinterpreted it here that we say we want to stop Bitcoin. We can't stop Bitcoin. Bitcoin is not an invention of 2015 or 2012. It's not even an invention of 2010. So how can Central Bank of Nigeria, not Central Bank of the world, stop the running and implementation of Bitcoin? So I needed to clear that we're not here to stop. We can't even stop.
Okay, sorry, the network went off. Okay, and the second one did not immediately turn on. Sorry for the inconvenience. Sorry, can you continue from where you stopped?
Okay,
Can you start all over again with the process?
Okay, you asked me to read the process.
The process. Yeah, start all over again.
Okay, any system, standard, protocol, convention, or rule that when applied to an input or input creates or has the ability to create outputs. Examples include strategic management processes, operational processes, and resource management processes. These processes typically are documented, but an organized workforce having the necessary skills and experience following rules and convention may provide the necessary processes that are capable of being applied to inputs to create outputs. Accounting, billing, payroll, and other administrative systems typically are not processes used to create outputs.
Okay. Thank you for that. Now you will find out that system is of no physical substance. It means something inbuilt that allow every other aspect of the input to work interchangeably in order to deliver an output, which you call operations, which is when you hear process, you are talking about what? Operations. Now, Economics Green Finance Professional Services Limited, can anybody use that as a study to say, does it constitute a business, yes or no, and why? You know what Economics Green Finance is also into? Okay, with the little you know about the company, is it a business? Yes or no, and why? The floor is open. The floor is open. I can't hear anybody. Olawale, can you speak to that? Olawale, are you there? Okay, Nuruddin, can you speak to it?
Okay. Fame polynomics, from my own understanding, I can say it's a business. It is a business in the sense that it has inputs, process, and outputs. Now, what constitutes input for fame polynomics could be the resources in form of educational equipment put together to support the lecture delivery and seminars and all other educational educational program that is being taken up. All those equipments all together form inputs for fame polynomics. For process, fame polynomics also has a management team that coordinates the operations of the lecturing, seminars, and other activities carried out by fame polynomics. However, the outputs for fame polynomics are the lecture delivered by the resource person and all the recordings, lecturing materials in form of outputs that the participants can make use of and make reference to after the lecture. That is my own position as far as fame polynomics is concerned. Thank you.
Okay, thank you very much. Who else?
For me, for the definition of inputs, the only thing that is making me to think is
not input. We are talking of process.
Process. I think the question is the filmometric a company, a business?
Yeah, the company, Fiponomics Green Finance, is it a business? Yes or no, and why?
And that's why I'm starting from input process to give my reasons why I want to take my position.
Okay, we are waiting.
Okay, I'm thinking from the definition, it must have an economic resources. And part of the resources is that ability to obtain necessary materials, which is a training institute. So he has the ability to, he has his material, his resources. And also, as Nuruddin have said, he has a management processes that is into. And as a result of that, is delivering output, which is the knowledge that is being passed or communicated to enhance others in becoming better in the field of accounting. So for me, I think it's a business.
Okay, you only speak to the input. Okay, yeah, continue.
So I don't know, let me just say, I think it's a business But a business that it has input processes, but I don't know if it has output. I'm not sure if it has an output. Input in the sense that yes, there's an intellectual property of the materials, there's intellectual property, and then the materials that are being provided by the company to help the educational materials to help people. Then processes, they have like a management that is in charge of his operations and stuff. But for output, I don't know if they have any form of dividends or they receive any form of benefits of, but it's still a business since it has inputs and processes. That's what I think, Sha.
Yes, now the investors are, we are the, for instance, we are like the investors.
Okay, you said something that you are not convinced it has an output. What is an output? Can you read it again and let's come back to that? Can you read output again?
It said an output is the result of inputs and processes applied to the business that provide or have the ability to provide a return in the form of dividends, lower costs, or other economic benefits directly to investors or other owners, members, or participants. Okay, sorry.
Yeah. What did you say?
And okay, so this line actually explains lower costs or other economic benefits directly to investors or other owners, members, or participants. So those who are utilizing Finponomics, they're like the members or participants, right?
Yeah, even the shareholders of economics have returns. When we say returns, it's not even, do you know that loss is an output, is a return, but negative return.
Okay. Okay.
Isn't that a return?
It is.
Now, two, the reason why the standard says that in some instances you might not have an output immediate is, for example, when you pick some companies or industry, like if you are going to start exploration, evaluation for oil and to start production, it's not the day you get the OPL license, oil prospecting license, that you now start to produce oil. It takes time for you to even discover oil, develop the well, and all sorts of things, which means in your first 5 years, you might not have any output that would drive towards giving you returns or anything because you are still at the early stage of development. The same thing goes for agricultural production when it comes to cash crop in a plantation. If you are starting agri today and it's not on arable crops, it's on cash, like I want to have a plantation for cashew, for cocoa, for rubber, for tin, for cotton. This is not something I will plant today and I will harvest tomorrow. My first 5 to 10 years might be for development of the plantation. Therefore, within that period, you don't expect any output. Or even if there's an output, it's going to be of a minimal impact. That's why we are saying that that limitation does not necessarily disqualify such a company as a business. Are you getting the logic? So that we don't misconstrue that fact. Now, the question then is, which will return to where we are. Is that until we identify that a company is a business, before we can even think of combination, which seems to speak to the fact that if at least one of the two companies involved do not qualify as a business, automatically any arrangement within them can never give rise to business combination. Which means the two parties involved, or if there are more than two, all parties involved must qualify as a business before the arrangement can be deemed to be a business combination. When we talk about business combination, or when we talk about combination, what is a combination? Combination is a coming together of two or more things. And when we now marry it together as a business combination, what do we mean? First, what is combination? Is it coming together two or more things. Now, if we now marry these together, we can now say business combination entails one, a situation where a business, not a company in this case, a business obtains the control of one or more other businesses. This is when we have a business combination, which means the key words involved here are one, those involved qualify as a business. Two, control exists in that arrangement, where no matter the amount, whether they are 2, they are 3, they are 10, one of them controls the others. Again, we can extend it in a form to say where two or more businesses come together to form a new business. And the new business they form is an enlarged business. And I will explain. I'll give you an example. Let me give you typical examples. Now, first, X, Y, and Z qualify as a business. That is the first assumption. Therefore, that assumption must exist and must be valid before we can even go forward. Now, we have one, where business X and business Y come together and they became business Z. Or business X come together with business Y and they form business XY. Or business X come together with business Y, but what resulted from it is an enlarged business X, which is not exactly this X, but enlarged. That's why I say it. And lastly, a situation where business X will still maintain its independent status as an entity, and likewise business Y maintain its own status as an entity. But what is common between them is that business X is seen to control business Y. Now, all of this can be considered a business combination. Why is it considered a business combination? Because what is key there is, number one, there's a business, and the transaction gives rise to a control. But what constitutes a control is a second discussion that we will have today. Now, that is that for now. Let's go back to our material. Now, what happens is that once we are able to identify that there's a business combination, we then need to resort to what kind of accounting methodology may be applied to account for this kind of transaction that has taken place. And from the provision of IFRS 3, it's only a single methodology that can apply. And that methodology is what is known here as acquisition method. Is what is known as what? Acquisition method. And what does acquisition method say? We'll go back to our slide, our workbook. Acquisition method is the only method applicable for accounting for any form of a business combination. Which means business combination takes various forms, but regardless of the form, is still one singular method that is applicable to all. And the method is what's known as acquisition method. But before we go into acquisition method, let us ask, what form can a business combination take? What forms can a business combination take? One, it can be by way of acquisition. Acquisition means you acquire another company without an intent to subsume that company, but rather to maintain that company as a separate entity, legal entity, but in which you exert your control over. A practical example of such in Nigeria is when NIMCO acquired Mobile Nigeria PLC. And today, Mobile Nigeria PLC is known as 11 PLC. And you can read that up in the material I shared with you. Let me show it again. I put something up on that. You can read that here. Example of Nigerian one is this. When NIMCO acquires state equity stake in Mobi, Nigerian PLC. Today, the Mobi still runs separately. NIMCO runs separately. But NIMCO controls the affairs of Mobi Nigerian PLC because he owns majority stake, or what I will call controlling interest in the latter. The other one you could have is a merger. In a merger, what happened in that situation is that one of the company at least subsume the others or the other, as the case may be. And a practical example that's fitting is what somebody mentioned with respect to Access Bank and Diamond. Access Bank acquired Diamond with the hope of subsuming Diamond. And that is why such acquisition was eventually described as a merger of Access and Diamond. Okay, who can tell me the distinguishing factor between the two? What is the distinguishing factor between the acquisition as I've explained it and merger as I've explained it? Miriam, you want to say something? Miriam, do you want to say something?
No, I'm not saying anything.
Okay. Anybody that wants to say something, use the practical example I've given to you in those two instances to distinguish between the two in a real sense with respect to business combination.
Okay, I would like to say something.
Okay.
Continue, John.
Okay, as you've explained that acquisition is not for the intent of, okay, acquisition is a form of business combination between two entities, but not for the intent of one subsuming the other. So the other company is still left to be an independent legal entity, but the company acquiring it exerts significant influence on it. While for merger is with the original intention of subsuming the other entity that is being taken over. So example of acquisition is the one between NIPCO PLC and Mobi PLC, that till today, Mobi still exists as a separate entity, separate legal entity, and NIPCO still exists as a separate legal entity. Whereas example of merger is between Access Bank and Diamond Bank, where Diamond Bank was subsumed into Access Bank. So that is my explanation.
Okay, thank you. Which means what you can conclude there is that the legal identities of the entities are maintained. Abi?
Yes.
But here, the other entity or entities are subsumed in the order that possesses the control. Does that make sense? Is that what your conclusion was?
Yes.
Sure. Thank you. Any other contribution before we proceed? Any other contribution before we proceed? Nuruddin.
Yes, sir. I have the same opinion with what Shegun just explained now. Because my own understanding as well is that acquisition is a situation whereby the intent of the two entity, both acquirer and acquiry, is not to subsume the other. Meanwhile, the entity will still be operating with their own entity name, just like NIPCO and Mobile that you use as example. That is for acquisition. And likewise, merger is just a situation whereby the intent is in such a way that one entity subsume into the other, especially the one that has control will take possession of the other that does not have control. That's one speak to merger.
Thank you very much. You've also broken it down in a manner that can simplify it. Okay? Yeah. Thank you. Thank you. Any other contribution before we proceed? Acquisition method. What does that infer? It infers that, one, in a business combination, there is only one acquirer. There's only one what? Acquirer. What does that mean? An acquirer is a business that controls every other business in that arrangement. Which then speaks to the fact that let us pick each of the strategy we've used for business combination. For acquisition now, the two entities involved were NIMCO and Mobile Nigeria PLC. Between the two of them, there must only be one acquirer. And in that case, who is the acquirer and why? Mr. Ludi Aboti.
Okay, I believe that NIPCO is the acquirer because NIPCO acquired a significant number of the entity shares. Actually, I don't have the exact figure, but I know that the NIPCO acquirer controlling a significant shares in Mobile. That makes NIPCO to be acquirer. Why Mobile is acquirer?
Who else want to contribute? Who else?
So like he has said, the acquirer is NIPCO because he has 60% significant interest and he has 60% control over the shares of the entire entity.
Can you have a percentage of control?
Percentage of interest, sorry.
Can you have a percentage of control? Because he said he has 60% control, which means control can never be 100%. That's what you're saying.
No, I don't get that.
You said NIPCO has 60% control. But my own understanding is that it's either you control or you do not control. There's no percentage of control. Does that resonate with you?
Yeah, so I changed it from control. I said 60% interest.
Okay. Now, let's look at the second one, merger between Access and Diamond. Even though one has been subsumed, probably before the subsumption, who is the acquirer in that business combination?
For Access Bank and Diamond Bank, Access Bank is the acquirer, while Diamond Bank is Acquiry, because Access Bank acquired more than 50% shares in Diamond Bank, which makes Access Bank to be the acquirer.
In a merger, there's no acquisition of shares. What you have is an exchange of shares in the enlarged entity, because the whole of those entities are subsumed in one another. Do you get the logic? Which means you can't use that phrase for what has happened between Access and Diamond. Because what happened is that you create the new Access is like what happened in this case. Can you see the screen? Okay, first, let me put it to you as a question. Can somebody tell me which of these four represents transaction between Access and Diamond? Which of the four?
It's number three.
Number three.
Exactly. You get it right. Which means the Access you are seeing is not necessarily that same Access here. It's now Access that is pregnant with something. That's why I stake it. What that means that this is a new business in principle. That's why if you go back to this definition, where two or more businesses come together to form a new what? Business. Now, the Access you are seeing today is a new business in principle, because it's a new business where certain exchange took place between the former Access and the former Diamond to have exchange of shares in order to create a new base in the new Access. I get what I'm saying now. And in that case, Access is the acquirer, which means there can only be one acquirer, even though there might be more than two parties to a business combination. What that presupposes is that every other party in a business combination, no matter the amount of them or number of them, they will be considered the acquired businesses or the acquiree. Does that make sense now? Yes. Which means no matter the nature of a business combination, there's only one acquirer. And why is that so? Is because it is the acquirer that will account for the combined assets and what? Liabilities of all the entities in the business what? Combination. Be it a merger or be it an acquisition. And if that is the case, let us come back here. In each of these 4 types of business or 4 examples of how combination can take place, can you identify in each of them who is the acquirer in each of these 4 examples? Just pick one and answer it. Another person pick one and answer it and justify.
Okay. Number 4. X is the acquirer. While is the
Who is the acquirer now?
X.
You said X is the acquirer. Yes. Okay, that's what we want to identify.
Yes.
Okay, who else? Who else? X is the acquirer because it controls Y in that case by way of acquisition of Y. Who else? We still have 1, 2, 3.
Number 1.
Number 1, who is the acquirer?
X or Y.
X or Y. What does that mean?
X can be, because the X and Y became C. So X can be the acquirer, Y can also be the acquirer.
We said there must only be one acquirer. Therefore, you are not giving me an option. How do you now separate them now? You are this wise man, Solomon. Yeah. Who should we give?
So if X is going to be the acquirer, it means he acquired more interest. Why, if Y is going to be the acquirer, it means he acquired more interest.
Okay, I will shock you now. Okay. None of them is the acquirer. Z is the acquirer. Let me give you a practical example. You know, Access and Diamond can also consume their merger by way of creating a new company totally. And that new company absorb both Access and this in order to create a new business so that people are not saying it is Access. They are not saying it's Diamond. But a new company rose from nowhere to consume the two, because they can create that special purpose vehicle to subsume the two of them and unveil something new, which you can call Platinum, which means when you now hear Platinum as a new company that was created, it is a company that has come to subsume Access on one side and subsume Diamond on the other side. Okay, 2 and 3. Who is the acquirer?
On number 2, XY is the acquirer.
XY is the acquirer. Thank you. And this, we've said it before. Okay, because this is the portion that represents the actual integration between Access and Diamond. Thank you very much. Now let's go further. What is critical about every combination, apart from being that businesses are involved, is what? Control. Is what? Control. Now, how is control defined? How is control defined? Now, there are 2 perspectives. First is by way of presumption, and second, by way of substance and reality. What does that mean? Even though it is rebuttable, where there are information that evidence otherwise, or to the contrary, But prior to that, it is presumed that a business controls another business if the former has more than half of the voting rights in the latter. Who can explain that? Who can explain that?
Okay, if I may try, voting rights arises as a result of the number of shareholding that one has in a business, equity participation in a by way of equity participation in a business. And if a single individual or an entity is able to acquire more than 50% of the equity shares of a company, that means he has more than 50% of the voting rights in that company. And in that way, he will be able to exercise control over that company that is being acquired.
Okay. Now, this is what we rely on during the days of the old standard, where emphasis was made on the issue of having more than half of the voting rights, which means once we have stake in the shares for more than 50%, we say we have control. But evidence has shown that that may not necessarily be, which we are going to see as we move on. But substantially, in today's world, control is based on you having these three in place. The first one is that the investor, which is the acquirer, has power over the investee, which is the acquiree or the acquired entity. Two is that the investor, by way of such acquisition, has exposure or right to variable returns. To variable returns from its involvement with the investee. And thirdly, that there is a link which establishes the ability of the investor, which in this case, the acquirer, to use his power over the investee in a manner that affects the amount of the investor's return. Now, I'll break it down. Three things are key in establishing whether contractually exists. One, is there power present such that for you to say you have control, you must have power. Now, do you have that power over the investee as an investor? That's the first one. The second one is, apart from having that power, does that power bequest in you the exposure or right to the variable return or to participate in the variable return? The word variable return means that as an equity holder, it is whatever the result is that you derive your value from. You have no guarantee return, which means if the company do very well, you earn very well. If they do poorly, you earn poorly. Which means, do you have the exposure or right to that variable return from your involvement in the affairs, both financial and operations, of the investee, which might be a subsidiary in that case? And thirdly, is there a nexus or a connection between the fact that your power is what is being used and directed towards ensuring you derive maximum benefit from the employee, from the investee? If this is the situation, it is more than evident that you have control. I get what I'm saying now. The same thing happens in leadership, also happens in family. Naturally, you expect the man to be the head of the family, but that may not necessarily be in all of the families. Because by natural law, you say the man is the head of the family. But by the economic and commercial substance law, the head of the family is who put the food on the table, is who takes responsibility of footing the bill. Are you getting it now? Which might be the woman, and the woman called the shots. Which means the first level is presumption based on all things being equal. But the reality of it is the second, which says it is who put food on the table that is recognized as the man at home or in the house. Because if you, as a man, cannot put food on the table, you can't be the one directing affairs to say, this is how it will be consumed. Telling the person that puts money on the table, this is how you consume it. It's just a common sense. And lastly, it is key that you might have a power, but you are not making use of your power. And that is the last point we need to establish. We have seen situations where you might be put in charge of something, but you don't control the situation. It's because you have the power, and that power can give you what you deserve, but because you lack that zeal, you lack that capacity to exert such a power towards driving your process or deriving your objectives. But for control to exist in its real sense, those three things must be present at all times. And that is why, as we move on, you will reach a time where we are going to establish the fact that situations exist where you might not have up to half of a voting right as a business, but you control other businesses with less than half. And situation also exists as we move on, where you have more than half of the voting rights, but you fail to control or you fail to possess control over the other. And we're going to see that as we move on. But in a nutshell, if there's no other information to the contrary, it will be presumed that when you find yourself in a situation where an entity or a business has more than half of the voting right in the order, such business will be deemed to have control of others. And that is that. And for those that want to write the examination for diploma in international financial reporting and the likes, one thing you need to know is that if information given to you is only limited to the information showing that you have more than half without any other secondary information to the contrary, therefore you reach a conclusion at that point in time that control does exist. Otherwise, if you have secondary information that point direction towards you contemplating whether control exists or not, you need to now refer or revert to the issue of the substance and reality of control. And that is that. Any question at that point? Now let me try and share something. Now, you can read further about the principle of business combination, which we have discussed, and the techniques that are adopted in structuring a business combination. Because within acquisition and merger, they can still be structured with different variants, which is what I'll put to you on the screen. Okay, but there's something I wanted to point your direction to. Okay, I think I'll bring that later. Okay. I want who volunteer to read this before we move further? Who volunteer? Marian Odum, can you read this?
Principle of business combinations and group accounts.
I know your network is bad. Sorry.
Combination of... Can you
I
hear
think
me?
your network is bad. Okay. Yeah. Okay. I can hear you better now. Can you start again?
Principles of business combinations and group accounts. Business combination involves the combination of two or more entities into a larger economic entity. Business combinations are typically motivated by expectations of added value, cost, tax advantages, coordination of the production process, and efficiency gains in the management of assets. The principle of group accounts is the need to reflect the economic status and substance of the relationship between the investor company and the investee company, even when the dual companies stand as separate legal entities. The principle further that since parent controls subsidiary, therefore they form a single economic unit or entity, the group. The companies included in group accounts are those as defined by IFRS 10 consolidated financial statements to constitute a group. An acquirer of a business recognizes the assets acquired and liabilities assumed at the acquisition date, fair value, and fair value, and discloses information that enables users to evaluate the nature and financial effects of the acquisition. Techniques adopted for structuring business combinations. The investor or acquirer can structure a business combination in series of ways that possibly satisfy the acquirer's strategic, operational, legal, tax, and risk management objectives. Some of the more frequently used structures are: one or more businesses become subsidiaries of the acquirer. As subsidiaries, they continue to operate as separate legal entities. 2, the net assets of one or more businesses are legally merged into that of the acquirer. In this case, the acquiree entity ceases to exist. In legal vernacular, this is referred to as a statutory merger, and normally the transaction is subject to approval by a majority of the outstanding voting shares of the acquiree. 3, the owners of the acquiree transfer their equity interest to the acquirer entity, or the owners of the acquirer entity in exchange for equity interest in the acquirer. 4, all of the combining entities transfer their net assets, or their owners transfer their equity interest into a new entity formed for the purpose of the transaction. This is sometimes referred to as a roll-up or put-together transaction. 5, a former owner or group of owners, a former owner or group of former owners of one of the combining entities obtains control of the combined entities collectively. 6, an acquirer might hold a non-controlling equity interest in an entity and subsequently purchase additional equity interest sufficient to give it control over the investee. These transactions are referred to as step acquisitions, otherwise known as piecemeal acquisition.
Can you repeat?
An acquirer might hold a non-controlling. I should repeat number 6, right?
Yes.
6, an acquirer might hold a non-controlling equity interest in an entity and subsequently purchase additional equity interest sufficient to give it control over the investee. These transactions are referred to as step acquisitions, otherwise known as piecemeal acquisitions, or business combinations achieved in stages. 7, a business owner organizes a partnership such as AVA corporations or FTC to hold real estate. The real estate is the principal location of the commonly owned business, and that business entity leases the real estate from the separate entity. The single economic unit concept focuses on the existence of the group as an economic unit rather than looking at it only through the eyes of the dominant shareholder group. It concentrates on the resources controlled by the entity.
Thank you very much. Thank you very much. Now let us go back to here. The question then is, where is the nexus between business combination and the requirement to present group accounts? And this will explain that to us. Now, I'll drop a line that separates these first 3 from the other one, which is the 4th one. What is common about these 3 that is not here? What is common about 1, 2, 3 that is not in 4? Who can explain? What is common in 1, in 2, in 3 that is not in 4? Who will explain? Madam Anayo, okay?
Yes, I think in the first 2, 3 is a combined, there's combination that if they are to present their financial statement, so it will be, one would say is a combined financial statement. why the fourth one will be a group. So that's
Okay.
what I can say.
If I can deduce what you have said is that the result or the outcome of the business combination is that a single entity is created.
Yes.
What it simply means is that only one entity come out of that combination at any point in time. Let us pick it for example. Access and Interconnector once had a merger, or what you may call it, and it was Access that came out of it. Similar thing has happened with Diamond. And what it simply means is that there's only a single entity that is the product of this combination. And when is a single entity that is a product of a combination, therefore, where is the group in it? Because the word group means that there are at least two people involved subsequently. But subsequent to this marriage, it's only one company that we can see, that we can deal with, that is operational. All because every other entity has been subsumed inside it. In that regard, therefore, it reverts to a single entity as if nothing has happened. Therefore, such a single entity does not qualify as a group. Because later on, will be made known that a group consists of a parent and at least a subsidiary, if not more. Whereas here, the two entities will still operate separately. And this is what gives rise to a parent and a subsidiary relationship, which means X is a parent here and Y is what? A subsidiary. This is the only instance where we have such a relationship, whereas such relationship of parent or subsidiary does not exist in this first stage. Does that make sense, please? Which then presupposes that it is only a business combination that involves this stage 4 or number 4 that will require the preparation of group accounts. Why? Because it is only that that creates a group. And it's only when you have a group that you prepare a group what? Account. And group account is the combined account of a parent and a subsidiary as if they are of a single economic unit or entity. Which then means that having accounted for the combination by way of acquisition method for 1, 2, 3, going forward, they have resulted to a single entity. Therefore, there is nothing like group accounts. But group account will only apply to this fourth situation where we have a parent and where we have a subsidiary and they continue to exist and operate legally separately. And therefore, you are required to combine the two accounts, and such responsibility lies with the acquirer, which in this case is the parent. And that is what necessitated the preparation and presentation of group accounts. Does that make sense now? Does that make sense now?
Yes.
Any question? Any question? What that means, where we stop is, yeah. Continue.
Yes, I understand. I understand the message, but there is an area of there is area I need clarification on. like Diamond Bank and Access Bank that comes together to form big Access Bank. Now, what type of account will Access Bank at the at their headquarters prepare at their accounting day, end of their accounting period?
Now, only at the point of acquisition, which is acquisition date, that they present a combined account which requires the acquirer to combine the identifiable assets and liabilities of the acquired business as part of his own. But going forward, that combination have already subsumed those assets and liabilities. By the time Assets will present its account at the end of the year, is a single company now. Therefore, it presents like normal company as a single account because there's no Diamond operating side by side with Assets. Unlike today, NIMCO operates on one hand, Mobi operates on another hand. That is where you still have to combine. But if I'm operating everything in a single bucket, therefore, what am I combining? Am I making sense, sir? Am I making sense now?
Yes.
Okay. Therefore, what constitutes a group? A group comprises.
Yes. Yes.
A group comprises of the following. A, the parent. And who is the parent? It is the business or entity that obtains controls of the others. And B, the subsidiary. Or if there are more than one, the subsidiaries. And therefore, what then is group accounts? Is the accounts of the parent and the subsidiaries as if it is the account of a single, I'll put it in quotes, economic entity. Remember, the word as if is a simile, qualifying it that it's not necessarily a single entity, like those of Assets and Diamond, but we want to view them from a perspective of a single entity. And that speaks to what Miriam read at the tail end of this material. Miriam, can you read it again? The single economic unit concept.
The single economic unit concept focuses on the existence of the group as an economic unit rather than looking at it only through the eyes of the dominant shareholder group. It concentrates on the resources controlled by the entity.
Thank you. And that's said all. Any other question as we wrap it up for today? Any other question as we wrap it up for today? Any other question? Any other question?
No question.
Okay. Without any other question, I think we've made justice to it. And tomorrow, God's willing, we will now introduce ourselves to basic principle of group accounts. Since we've now understood what leads to the preparation of group accounts, the next journey is to say, okay, what process do we need to consider or pass through in order to meet the requirement of preparing and presenting group account in line with the international financial reporting standards? Okay, all what we have considered today are all within the ambit of the International Financial Reporting Standard 3, which talks extensively about business combination. Thank you very much, and God bless you.
Yeah, thank you too.